Welcome to the Douglas Social Credit Podcast. My name is Dr. Oliver Haydorn, and I'm joined today once again by Will Waite, and we will be discussing the nature of money, the different types of money, how money is created. Because even today in 2024, when most everybody should know better, there are still a lot of people who hold very misleading, erroneous ideas about what money is, where it comes from. And so it's sort of a preamble. In order to understand Douglas social credit properly, we first have to explore this question of the origin, nature of money. So we'll do our best to explain this in a way that most anyone can understand. And perhaps we should start with what is money? How would we define money? So Douglas was in the habit of quoting a certain Professor Walker, and that's sort of the standard definition that we use in social credit theory to explain what money is. And I don't want to put you on the spot necessarily, Will, but could you tell us what Professor Walker said about money? Money is,
If I recall rightly, it is anything which will not be refused, and anything which something which nobody will refuse in exchange for his goods, something like that. Is that
right.
right?
That's right. So Professor Walker said that money can be anything. It can be made out of anything, provided that no one is going to refuse it in exchange for his goods or services, provided that there's a willing seller. So money is basically a ticket. It's a ticket that is a claim on goods and services, and it's what makes the vast majority of economic activity possible. Now, we have a habit because we are, physical embodied creatures. We have a habit of thinking about money as something physical, and a certain percentage of the money supply does exist in a physical form. So we're talking about notes and coins, but this is actually a very small percentage of the money supply, right? So the notes people have in their wallets or the coins that they have, and this is a state form of money. It's created by a reserve bank, a central bank, etc., or a mint that's been charged to create these things. This is actually a very, very small part of the money supply. The greater part, the greater portion of the money supply, we're talking 95% or more, actually is not physical at all. And maybe you could talk a little bit about that end of it, that portion of the money supply that is not physical. So what are we talking about?
So the vast majority of the money supply comes into an existence in the form of loan credit created by the banks when they lend money. So this is not something that people readily understand. So what it means is that the vast majority of the money supply is attached to a corresponding debt. And of course, the vast majority of the money supply also carries interest charges.
Yes.
Now, let's just go through the process a little bit. If I want $100,000 to buy a house, that's a pretty cheap house. But if I want $100,000 to buy a house, I would go into the bank and I would say that this is what I want to do. The bank would assess my financial situation. That is, they would assess my ability to repay the loan and make the interest charges. And if they found that I was able to service the debt, they would draw up the contract, and they would deposit, though they don't necessarily deposit. They would deposit money into the $100,000 into my account, and that would readily be available for me to use. Well, in that case, the money would be transferred, I think, to the seller of the house, and the seller of the house would then be free to use that money anywhere in the economy. So in every real sense, that loan credit, which has been created by the bank for me to buy that house, and which is transferred to the seller of the house, is in every way new money. In that the person who holds that money, the seller of the house, no one will refuse the transfer of those digital dollars into their account for goods and services that that person wants to buy. So the money supply has been inflated by $100,000,
Mm-hmm.
and that's essentially where the vast majority of our money comes from. And this is true. Like, a lot of people probably have the idea that governments create money. Now, the process is slightly different in that rather than the bank drawing up the loan contract, it's actually the government provides something of the contract in the form of a bond or another type of sort of treasury commitment to repay, and a bank will buy that financial product, which the government will then have to as the security matures, they will then have to repay that in money. So the government doesn't create money either.
Mm-hmm.
Okay, they're subject to more or less the same rules as the private borrower.
Yes.
Have I got that fairly right?
Yeah, I think so. So the bottom line basically is that the bulk of our money supply exists in the form of intangible bank credit, digital entries, which banks create whenever they make a loan or purchase, even when they buy securities, for example, or they even pay for their operating expenses. They simply enter these digits in their accounts, and they're basically expanding both sides of the balance sheet. So the asset side is increased and the liability side is increased. And it's a kind of alchemy. I mean, it's an astonishing thing that the banking system creates this money by an act of fiat under certain conditions. Of course, it's not arbitrary or it's not haphazard, and someone has to create the money supply. So it's not that it's intrinsically wrong to create money in this way. Basically, what we're insisting in the Douglas social credit movement is that this process of creating money should, in an optimal way, serve the needs of the wider society and not disproportionately serve the interests of an elect few at the expense of the common good. So in other words, we should all benefit on some equitable basis from this money creation process. And as long as the natural law is respected and the public authority is able to regulate finance appropriately, then there's no inherent problem with this form of money creation. So sometimes you have people who insist that money is actually, it should be something like gold or silver, something physical that's limited and scarce, and that this puts a necessary discipline on the money system. And there is a need for discipline in the money system, for sure, but we would argue that tying money to a scarce metal like gold or silver actually introduces potentially too much discipline. And the money system needs to be sufficiently flexible so that we can create enough money to catalyze whatever goods and services we desire and to distribute them in full. And we don't want a system where we can't do stuff because there's not enough gold or not enough silver to justify the creation of the money to do what is physically possible. So one of the basic principles of Douglas social credit is that whatever is physically possible should be financially possible. And that relationship is the kind of relationship you would have if the financial system were an honest system, if it were designed in such a way that it accurately reflects the physical capacity to produce goods and services, as well as the flow of real wealth.
Well, I guess money's a symbol, isn't it?
Mm.
And the question is, well, what does it symbolize? Should it symbolize the quantity of gold that we have available? Well, what's the utility in that? I mean, there's nothing to say that there is any proportional relationship between the amount of gold in existence and the amount of business that we need to do.
Mm.
So I mean, what money actually symbolizes, and this is inherent in how actually, it is reflected in how banks do create money. I mean, when I go in for that loan, the bank assesses my real economic position. Like it says, oh, you own a property of such and such a value, or you have a job that is valued at this much over this amount of time, and it makes an assessment about how much to give me based upon my real wealth position.
Mm.
So in a way, like it's not an honest system, but in a way, even the present system is tied to
Reality.
the real wealth position. The volume of money created is tied to the real wealth position of the borrower.
Mm. Yeah.
So we that's more or less the principle which we want to refine, I suppose.
Mm-hmm. Or extend.
And like Douglas pointed this out a lot, like the fraudulent aspect that we try to highlight is that the bank's ability to only ever loan this money is actually a claim by the banking system that it owns the wealth which is underwriting its lending.
Right.
And this, of course, is a perversion of the real situation. The wealth is the real and potential productivity of the community.
Mm.
And it is not owned by the banking system. The banking system is the accounting mechanism.
Mm-hmm.
It's like the bookkeepers have ascended to the throne.
Right. Right. So in our view,
And,
banking should be basically a community service. We're not asking or expecting the banks, of course, to operate for free or anything like that. They should be paid for the services that they render. But
well,
it should be, the policy of banking should be arranged in such a way that the needs of the community come first. And it's on that basis that we then reward the banks, depending on how well they actually serve the real community. Yeah. Another important point, just to clarify, we talked about the creation of money, bank credit, out of nothing simply by expanding both sides of a bank's balance sheet. It's also important to understand that when a loan is repaid, or when a security is sold to, outside the financial sector, that money is also destroyed. So the bank credit, when you pay down a loan, that bank credit is also destroyed to the extent that the loan is being paid back. And so money is being created and destroyed all the time. It doesn't cycle indefinitely in the economy. It's something that is coming into existence, going out of existence, and that has important implications, which we'll probably discuss in a later podcast. But it's very ephemeral. The money supply is very ephemeral. It's being created, it's being destroyed through this mechanism of expanding a balance sheet and then contracting the balance sheet.
I would say just on that point that what that means is that the system has to continually find people or organizations or governments that are willing to go into debt.
Mm.
So if you have a situation where the economy is not functioning very well, or then people are not willing to take on debt, or it's going to be unpopular for governments to take on debt, then basically you're looking down the barrel of a recession.
Mm-hmm.
Because you have to have sufficient money in cycle in order for the economy to function properly.
Right.
So there's a lot of like it's not obvious unless you're looking for it, but there's a lot of government policy is about trying to stimulate borrowing in order that the economy functions, somewhat
Tolerably
properly.
well. Yeah, that's right. There are also certain misconceptions that people have, even when they do understand that, the banking system creates money. So You have things like the multiplier theory, or fractional reserve, and whatever may have been the case in the past. Uh, we know that the modern banking system actually doesn't work on a fractional reserve basis as such, because the whole idea of fractional reserve is that before you can create digital bank credit, let's say in a loan, you have to have the currency, the reserves in place first, and that you can only create a certain percentage of those reserves in the digital bank credit. Whereas we know that because the modern economy needs more flexibility, more elasticity, we know that the banks actually will create money, create digital bank credit to the extent that it can be justified on economic basis, on an assessment of the real world position of the borrower, like you were saying, and then they'll find the reserves after. So they'll borrow the reserves from another bank, perhaps, or from the central bank if necessary. But the reserves are sort of a secondary process in the way that the
Not a limiting factor.
not a limiting factor in the way that the fractional reserve systems, or the fractional reserve take on the banking system, would suggest that it is.
I think the dominant theory at the moment is actually just that banks operate as financial intermediaries.
Hmm.
And that theory just says that banks don't create credit at all, that they essentially just loan deposits.
Mm-hmm.
And this is probably, yeah, as I said, it's probably the dominant theory at the moment. But of course, it's not true. Like, there's nobody goes into a bank and says, "Oh, I want my money," and
Mm-hmm.
the bank says, "Oh, sorry, we loaned your deposits."
Right.
I mean, the credibility of the banking system would collapse pretty quickly if that was what was happening.
Right. So even apparently in certain banking textbooks or economics textbooks, there's still this idea floating about, which, as you point out, is probably accepted by quite a number of people, that banks are lending somebody else's money, right? That somebody's deposited money, presumably it may be notes and coins. People are still thinking of money in physical terms, and that the bank is then lending that money out to somebody, and it doesn't work that way at all. Right? A bank is not connecting savers and borrowers. So that's utter
No.
nonsense. And the interesting thing is that C.H. Douglas, exposed that many, many, many decades, like 100 years ago. Right. So
Yeah.
it's and yet we still, in the public consciousness, we still have not clarified that sufficiently to the point where no one still holds that erroneous idea. So you can see how slow progress has been in understanding how the financial system actually operates.
I think it's a good lesson in how something can remain relatively unknown if you just decide not to talk about it very much.
Mm.
Like, the evidence that what we're saying is true is widely available.
Mm.
Like, the Bank of England published a paper called Money Creation in the Modern Economy, and it's very clear about how banks create credit, and that what we're saying is true. And I think it was in 2014, an English economist, Richard Werner, published another paper which empirically showed that banks do create credit out of nothing. Banks individually can create credit out of nothing. He asked the bank if he could, actually take out a loan, and he'll be allowed access to their books and their programs, etc. And the results were published. So he says, in the 5,000 years history of banking, in 2014, I think we showed empirically that banks do create credit out of nothing.
Mm-hmm.
So the evidence, there's heaps of evidence, and there's a lot of other evidence for this. There's heaps of evidence that what we're saying is true, but it's just economists don't talk about it. In fact, it's astounding that as far as I know, even to this day, the economic modelling does not take the behaviour of banks into account. Like we have, as though, the neutral veil of money, as if the money supply, you know, the way in which it comes into existence and its nature and so forth, doesn't actually affect our economic dealings.
Mhm.
It's quite bizarre.
Right. Whereas from a Douglas social credit point of view, we're saying that the financial system, the banking system, how money is created, how it's destroyed, that this has such an impact on the real economy as basically its soul, its driving force, it's its organizing principle. And if there's
Yeah.
something wrong with the way that system interacts with the real world, there's going to be a real world fallout, in various ways. So we need to get the money creation system right. And that's what Douglas social credit intends to do. That if we're going to create money in the form of bank credit out of nothing by an act of will, there are ways of doing that that will serve the common good optimally, that will liberate the real economy and ensure that we can deliver the goods and services people need to survive and flourish with the least amount of labor and resource consumption. And then there are ways of doing that which misdirect economic activity, which put artificial limits on economic activity, which create all sorts of dysfunction, massive dysfunction from which we all suffer. Even people who think that they're doing well out of the current system suffer negative fallout from that. But as I said before, we can understand the Douglas social credit analysis and the remedial proposals. It's necessary to have clear and correct ideas about how the current banking system actually provides the bulk of the money supply. Now, sometimes people talk, especially people in the conventional right wing, libertarians, Austrian economists, and others, they talk about the government printing money and that this causes inflation and so on and so forth. But as you alluded to earlier, the government's not literally printing money. The government might be instrumental in the expansion of the money supply, which nevertheless requires the cooperation of the private banking system. And that expansion could be prudent or imprudent. But there's actually, literally, it's not a question of the government actually printing more dollars. Yeah.
No, and the cooperation, or the cooperation of the treasurer and the banks is an interesting subject. I mean, who's running who? Obviously, before the government can expand the money supply, it needs to have, in some form, the consent of the banks. And Douglas described the money power as a sort of hidden government. And I think that's the situation that we find ourselves in today, that behind the governments which we give so much attention to is this power of the money supply, which is really able to significantly influence the situation behind the scenes. And of course the politicians and the governments are the ones that mainly receive the attention for the success or failure of any given program. But right. It's all got the sense of the financial powers. It must do.
Right. So you have the idea here that he who pays the piper calls the tune, or he who has the gold makes the rules. That the money power nationally and internationally is really at the top of the pyramid of power, really, because when you can control money, the conditions under which it's issued, etc., you directly or indirectly control anything and everything else that is in any way dependent on the issue of money for its operation.
Mm. Which is nearly everything.
Which is nearly in the modern society, it's nearly everything. That's right.
Yeah. I mean, the role of money is, Douglas said, it's to enlist the cooperation of the community and the use of its assets.
Mm.
So what can you do if you can enlist the cooperation of the community in the use of its assets? Anything the community can do.
Right.
I mean, I think this is why we get submarines. We
Mm.
get $360 billion worth of submarines. I mean, that didn't come from, that's not the idea of private citizens.
Mm-hmm. Right.
To
Right.
build submarines, for instance.
Yes. Yes. So yeah, that you have this whole policy dimension that, if money is granted, then certain things can happen. If money is not granted, then certain things which might be very beneficial to the community, very beneficial to individuals, will not happen. So you have this whole dimension of, giving a green light or giving a red light to various projects, and rewarding and punishing certain sectors of society depending on how well they fall into alignment with the agenda of those who own and control the money supply. Right. And we are of the opinion that since the labor, the raw materials, the real capital belongs to the citizens, as well as things like the increment of association, the cultural heritage, this is something that belongs to the individual citizens of a nation. Therefore, if the financial system were designed to reflect the physical reality, there would, in some significant manner, the creation of the money supply should be regarded as a service to the community, and that just as the community owns the physical assets, the physical components of economic production, they should also, in some significant sense, own the financial symbols that represent that. And that's not something for any private organization to monopolize as if it were their own private asset or prerogative, to then advance their own objectives at the expense of the best interests of the community.
And if we can properly distribute money to citizens, money can actually be a force for democratizing the economy. Rather than it, which we see constantly, the power of the economy constantly being concentrated in larger and larger organizations, especially financial organizations. If we can distribute it properly to citizens, then the consumer can have some control over production, and we get a democratizing effect rather than the concentration of power like what we see pretty much everywhere in the world.
Right.
Like the financial mechanism is the most efficient mechanism for the concentration of control.
Right. So, but it could also be, if it were, redesigned, re-engineered, it could also be the most important vital mechanism for the distribution of power in society. So what we want is a distributive system that would, instead of centralizing power, it would decentralize power, and ensure that every individual could have at least a minimum of financial power as his claim on the product of the community, because he's rightly regarded as a shareholder in his society.
And material security to the extent that the real economy can provide it and does provide it.
Yeah,
I think is important.
Right. Now, is there anything else on this subject of money creation, money destruction that you wanted to add? I think we've covered most of the main bases. I mean, of course, we could elaborate on any of these points for hours, probably, but I think perhaps we've given a good overview or introduction for people that are unaware of how the banking system actually operates. Is there anything else you wanted to?
I think we might leave it there.
Yeah.
That's a fair mindful if
Yes.
you're not familiar with the subject.
Yeah, fair. We don't want to overwhelm people. Very good. So our websites again are
Socred.org
so correct.
is Oliver's website, and thepeoplescredit.com.au. There's heaps of stuff there. Go and check that out. And thanks for listening.
Yes, please like and subscribe, and we will join you again next week on another topic related to this sphere of Douglas social credit. Thank you for watching.
Bye for now.